Welcome back to another video in the Futures Exchange series. This video is going to be more technical rather than conceptual when it comes to learning about futures. The goal of this video is for you to understand what margins, leverage, and risk is. And there will be more stuff, but these are kind of like the main ones we're going to talk about. So in future trading, you don't pay the full value of what you're trading, right? That's one of the key differences from stocks or even real estate. Instead, you post something called margin, which is a small percentage of the total contract value. Now, this is not a down payment and it's not a transaction fee. You're not buying anything upfront. In this context, margin is like a performance bond. It's a deposit you put up to guarantee that you can cover your side of the contract if the trade goes against you. You could kind of think of it like a security deposit when renting an apartment. You don't own the apartment, let's say, but you're putting down money to prove you can be trusted with the follow to follow the terms. And obviously, if something goes wrong, like damage or default, the deposit is used to cover it. This is kind of how a margin works. The future exchange is set of two margin levels for every contract. There's the initial margin. This is the amount you need in your account to enter the trade. It is required at the moment you open a position. So for example, you need to have, let's say, $1,000 to trade one E-mini S&P 500 contract. There's also the maintenance margin. This is the minimum amount you keep in your account to continue holding the trade. So if your account balance drops below this level due to losses, you'll get a margin call, which we'll cover in the later slide. And for example, the account needs to be above $500 American for the trade to be active. And if your account falls below $500, the position will close right away, unless there's something called margin calls where you get a call. But sometimes they just close the position out right away. And so the actual margin amount depends on a few things. There's the type of contract, let's say S&P 500, natural gas, oil, they all have their own margins. The volatility of the asset, which is kind of like the type of contract, and market conditions. So exchanges can raise margin due to more volatile times, which kind of just goes back to the first point. So like in short, basically margin is what gives you access to the future market. It allows you to control large positions with limited capital, but it also introduces risk. Because your entire trade is riding on a small deposit. And then one of the defining features of future trading is leverage, right? What makes futures both exciting and dangerous. So what leverage means simply is leverage means you can control a large position, financial position, with just a small amount of capital, much smaller than what the full asset is really worth. Let's say a single futures contract, where this is going to be a hypothetical, is worth $100,000. To trade it, you only need to post $5,000 in margin. That means you're using a 20-to-1 leverage. Your deposit is just 5% of the full contract value. Obviously, there is a catch. Your profits and losses are still calculated based on the entire contract, not the 5,000 you posted. So if the price moves 1% in your favor, you can make $1,000 in the snap of a finger. That's a 20% gain on your $5,000 margin. However, if the price moves at 1% against you, you lose $1,000 and a 20% loss to your account. That's the double-edged sword of leverage. It can amplify your gains when the trade goes right, but it could also magnify your losses when things go wrong. And because the future markets move quickly and are often volatile, leverage makes it possible to lose a large portion of your margin in minutes or hours, not days or weeks. In other words, leverage is leverage is very powerful, but it's not free money, and it increases both your opportunity and your risk exposure, so it must be used carefully. If we watch the risk and return video, it's like high risk, high reward, or high loss. So high risk, high reward, or high loss. So back to the margin calls. So what happens if a trade starts moving against you? Let's say you opened a position of $5,000 in initial margin, right? The market moves the wrong way, and now your account value drops to $3,800. But the maintenance margin for that contract is $4,000, meaning you could only lose $1,000. That's the minimum you need to keep the position open. Since your account fell below it at 3,800, you'll receive a margin call. A margin call is exactly what it sounds like. Your broker is telling you to send in more funds, or they'll forcefully close your trade to limit risk. just to quickly say is if you're trading like a prop firm account or anything of that, margin calls, they're no calling you. They would just close the thing right away. You won't be able to trade for the day. There's max drawdowns and daily drawdowns. This is kind of like your margin calls in their sense. It's different, but it's the same concept. And so back to the margin calls, your broker is telling you to send in more funds, right? And you usually have a very short window to respond, sometimes hours, minutes, or especially in fast moving markets like oil index, it's quick. You get the margin call quick. So if you don't act in time, the broker will close a position whether you want them to or not. You don't have a choice anymore because you broke that like rule, I guess, the margin rule. And if the market moves significantly against you, that can mean a large realized loss, one that couldn't be avoided the one that could have been avoided with better risk control. Margin calls aren't about punishment. They exist to actually protect your account and the brokerage. If your losses grow too large and you have no more money in the account, the broker can't recover the difference. So they use margin systems to step in before things spiral out of control. So like kind of like the bottom line is with leverage, a small losses become big problems fast. And if you're not managing risk, you may not get a second chance. So I'm going to give you a quick world example just to soak in this concept. So imagine you buy one crude oil future contract, right? Each contract represents 1,000 barrels of oil. So if oil is trading at $85 a barrel, the total value of the contract is 1,000 times 85, which is $85,000. But to take this position, the trader doesn't need $85,000. They only need required margin, which we'll say in this case is $59.50. That is less than 7% of the contract's full value, which is where like leverage gets its power. The key part is if price of oil rises by $2 per barrel, the contract gained $2,000 in value. That's because $2 times 1,000 barrels is $2,000 profit. So on a $59.50 margin, your return is roughly 34% on just a $2 move, right? It sounds great, it's amazing. However, what if oil drops by $2 instead? Then you are losing $2,000, and that's a 34% decrease in your account, right? It just as fast. So these small price moves happen all the time in the futures market, and because the contract size is large, the impact on your account can be huge, even if the market doesn't move that much in percentage terms, right? Because that $1, $2 change compared to 85 contract, it's not 34%, but when you bring in leverage in here, it's 34% gain or loss. That's why futures trading feels very intense, and you're riding a large position with small cushion. Yeah. So up until now, we've seen how like futures trading involves big exposure for small deposits and how quickly things can go wrong if you're not prepared. This is also where risk management comes in, and it is not optional. You should have a risk management strategy. The most important thing you could do before placing a trade is always ask yourself, how much am I actually risking, right? That means both in dollar terms and as a percentage of your account. For example, if each point on an index contract is $50 and your stop loss is 10 points away, 10 points is every dollar switch, dollar tick. Tick is every movement, point is $1 increase or decrease. So if your stop loss is 10 points away, well, you're risking $50 to $500. And if your account's 5,000, then losing those 10 points, that's 10% of your account you're losing, which a lot will ask, was that acceptable to you? I would say no. I'd hope not, but that's a big change. So one of the most powerful tools in trading to avoid these, or to kind of help you have this risk management strategy, is the stop loss order. So basically what a stop loss is, it's an automatic instruction to close your position if the price moves against you by a set amount. It helps prevent small mistakes from becoming big ones, right? Another key principle is position sizing. Just because your account has $10,000 in it, it doesn't mean you should use all of it in one trade. Start small, especially when learning. Yes, in theory, if you go all in with your money, you could make a lot more, but you could also lose $10,000 really quickly. Also, avoid falling into the trap of using all the margin available to you, which is kind of like going in all in. Yes, your broker may allow you to open 5 contracts, but should you really? Probably not. Using all available margin leaves you no room to survive normal market swings. What this means is a lot of the times people enter trades and the prices will go against them. But this is all with liquidity, so it will go against them, and they might be down for a couple minutes or not. But the thing is, they know where the stock is going, and it will dip down a little and go against you, but then eventually it'll go up even higher. So you will make the money. But the problem is if you go with all in your money, taking those losses, you can't, because your margin is going to get hit right away and you're going to get a margin call. So you need to leave some space for yourself for loss, you know? So avoiding to that trap isn't such a good thing you can do. You should also remember leverage doesn't multiply reward, it multiplies risk. And all the successful future traders aren't just good at picking trades, they're good at protecting their capital, which is just as important. And they think in probabilities, they define the risk before entering and call losses quickly, you know? Very, very simple. You should always be able to cut your losses, and taking a small loss is much better than taking a big loss. I was going to point that out there, because I've had some days where I had huge losses and I regret them so much because I could have just closed the position earlier, and I knew I should have closed the position early, but I didn't. Yeah. So that pretty much sums up margin leverage and risk. To quickly wrap it up, first I want to remind you, margin is your gateway to the future market. It's a deposit, not a payment, that kind of gives you access to a much larger position. But that amount is still small for a reason. It's not enough to absorb big losses. Second, we have leverage, is what makes futures powerful. It allows you to trade large dollars amounts with limited capital, but it cuts both ways. The same leverage that multiplies gains can just as easily multiply losses. Third, all your profits and losses are based on the entire contract value, not the margin you posted. So a small price move can cause a huge swing in your account, even if the moves was only 1% on the chart, let's say. Fourth, if the market goes against you and your account drops below the maintenance margin, you'll face a margin call. If you don't act fast, your position can be closed at a loss automatically you have no say. And last but not least, and most importantly, none of this works without a risk plan, right? Futures aren't for gamblers, they're for disciplined traders who protect their capital, use stop losses, and understand position sizing. You should also be able to respect the math behind margin and leverage. In the next video, we will apply this knowledge to real market setups. But I do want you to remember that your first job as a trader is survival. Master that, and your profits will as well. Thank you.